They really are. And a lot of it comes down to content. I think Netflix had a really strong slate of content in 2022, and they finished the year off with a few, very popular TV shows, miniseries, and movies. But the other thing to keep in mind with that chart that you have up on the screen is that total hours is a function of not only time spent per person, but also total number of users on the platform. And at Sensor Tower, we're looking at the use across mobile applications. And Netflix in the US is still more than twice the size in terms of monthly active users than its closest competitors in Disney Plus and Hulu. And then it's significantly bigger than some of those more tertiary streaming platforms like Peacock, like Paramount Plus and HBO Max. So it's not only doing well in terms of engagement, but also the sheer size of the user base is contributing to that 52% share.
Can they increase it? Or, is there a limit in terms of how much traction they can draw and how much brand premium they can hold in this environment where competition is increasing?
It's a great question to ask. And I think it's what Netflix is trying to figure out right now. And that's why you're seeing them try ideas like the ad-supported tier, having different entry points for more price-conscious consumers. Also with the password sharing restriction that's going to come into play, where people who are sharing passwords with their parents and their ex-girlfriends are no longer going to be able to get that content for free. So I think the idea there is like there are still levers left to pull. And I think as we look at 2023 too, Netflix's focus on streaming is something that probably separates it from some of its closest competitors like Disney, like HBO Max, like Paramount, and those are streaming services that are part of much bigger companies with all sorts of business streams and mouths to feed in terms of entertainment. Netflix can really focus on what's on the streaming platform. So I think those are things and reasons why there's optimism for Netflix moving into this year.
But I've got to ask you, Anthony, because so many of these platforms that you're mentioning that are part of broader conglomerates, they're all seemingly starting to focus in on sport, which everybody knows is an absolute ratings winner across the board, particularly the NFL. The NFL absolutely dominates, and you know this, it absolutely dominates. So do you think that there's a concern because Netflix is saying it's too expensive to get into sports, that is what's going to be the trigger or the catalyst that's going to perhaps make it so that those other streaming platforms start to eat a little bit of Netflix's lunch?
Yeah, I mean, I think Netflix in the medium term probably needs a foothold in some sort of a sports league. In the Sensor Tower data set, we saw significant bumps for Amazon Prime Video on Thursday Night Football, not only the first game that they had in September, but on all subsequent Thursdays, there was a very noticeable pop in not only new installs, but in users. Obviously, Disney having the ESPN property as part of its bundle is something that it can offer its subscribers. So I do think Netflix has to think of ways where it can have access to a sporting property. But Netflix has already looked for ways to diversify beyond just streaming video content. I think its move into games and trying to turn some of its more popular video franchises into mobile games is a step in the direction of knowing it needs to be more than just video. It needs other forms of entertainment to satiate the consumer.
But games are so overcrowded already, Anthony. How much ground can they break there?
Games, yes, it's a very tricky market to get into. I think Netflix has a little bit of a built-in advantage because it already has so many users on the video platform that not only can it leverage successful IP, but it could also direct people who are watching a Stranger Things video to playing a Stranger Things mobile game. I don't think games necessarily has the impact that sports would, but I think it does signal Netflix's desire to offer more forms of entertainment to its core audience.
Do you think we're going to get into an arms race in terms of content spend? Because with all of these other companies that do have considerable heft, like Apple, like an Amazon, and you just have to look at Lord of the Rings, how much money they spent on that project. Do you think that Netflix, they're looking for $3.3 billion and plus in terms of FCF, but they might have to spend a little bit more on content moving forward?
Probably. There's so much incredible content out there on these streaming services. I'm going to need to take some additional time off of work to catch up. But I think if you look at the Sensor Tower data set, we do see noticeable pops in engagement and in downloads after these pieces of tentpole content here hit the market. Netflix on their earnings report cited the success of Wednesday in the United States, which is the Addams Family show. We saw similar, albeit slightly higher pops when Stranger Things season 4 was on in the summer. A year ago, Squid Games was a phenomenon. You mentioned the Lord of the Rings show on Amazon. There's the Game of Thrones prequel on HBO Max. All these significant pieces of content do bring eyeballs with them. But what we've seen as to the other side of the coin is sometimes that halo effect around a really popular piece of content is somewhat fleeting. So it becomes not only an arms race, but like you have to be very consistent with having that tentpole content to make sure that users aren't just dropping the service immediately after a season concludes, because the switching cost and the friction is so minimal. You can just sort of unsubscribe from one service, move over to another app, resubscribe for another month, and catch up on all the content you've missed.